It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the show. With me in the KFG studios, Kevin Korhorn and Josh Gregory.
Riddle me this, Mikey B. Should you be optimistic about the stock market for the rest of 2020? Or is there reason to be pessimistic? In either scenario, how should you position your portfolio for the best chances of success in the second half of the year? We're providing our insights and more coming up this hour on Wise Money.
I'll take that riddle, Kevin. I'm up to that challenge. We're going to talk about that. If you have questions, we've got some great questions from fans of the show. Reach out to us. You can find us online, wisemoneyshow.com. Submit a question right there. Call or text 574-222-2000. That's 574-222-2000. But let's face it, most of the questions come in on social media. You'll find us wherever you're at. Just search the Wise Money Show. YouTube channel, Facebook, Twitter. We get a lot of questions there, so just search the Wise Money Show. Follow us there as well. Oh, my goodness. So have we broken a record for the most financial headlines in a year thus far in 6 months? It's possible. It's possible.
Dominating everyone's news feed, isn't it?
But let's say you were hibernating, which sounds really appealing, by the way. You were hibernating at the beginning of the year, and you just woke up. Or you did what Josh says, right, Josh? You say, don't look at your investments. You look at your investments twice a year, right around the beginning of the year, right around the middle of the year, and you shouldn't look at them at all. So let's say you were that disciplined. You'd wake up or you'd look, and midpoint of the year, the stock market's down about 4 or 5%. No big deal. Bonds are up a couple percent. And you think, well, that's pretty boring. And it's been anything but boring. And if you get under the surface, that's where you get to see the problems, because small caps are down 15%, international's down 15%, real estate's down a bunch. And obviously, you know, the road from starting the year to down 3 or 4 for the stock market was not a straight line. Yeah. You know, that was crazy. So here's the deal. There's tangible reasons to be optimistic from here. But obviously, there are lots of people that are cautious. So which way should you be? And we're going to lay out the reasons to be cautious or pessimistic and the reasons to be bullish or optimistic. And and then we're going to apply it to your situation, tell you what you should be doing in face of all this uncertainty. So given the choice of, hey, I've got good news and bad news, which one do you want to start with? You always start with the bad news. You always do. So there's a little advice for you this hour. So let's start with the bad news. Why should you be cautious? What are the reasons to be pessimistic or cautious about the overall stock market?
Well, can we start with the obvious one first? You know, that little virus that's been going around the whole world here that took away your sports this spring and maybe canceled your vacation, disrupted your kids' school, and maybe even shut down your favorite restaurant. All of that has an impact on the stock market, too, on your investment portfolio. Whether you are a CD investor at the bank, you've been affected.
Oh, yeah.
If you've got mutual funds and a retirement plan at work, you've been affected. Even if you're a stock picker yourself, you have been affected by this and really are likely to continue to see volatility this year because of the coronavirus. And it is so unknowable what kind of lasting impact it has had on our economy and on individual companies or entire industries. And that is being worked out. It is being figured out every day in the stock market as more information becomes available. And so the coronavirus is it's one of those clouds of uncertainty that's still hanging over the investment world. So if we're starting pessimistic here, the fact that we still don't know how the coronavirus is all going to shake out, when it's going to be in the rearview mirror, is part of the reason why many people are looking at the stock market's performance here recently and saying, well, boy, can I trust this run that we've been having?
Yeah, and I don't like to ascribe my reasons to why the stock market's doing anything, because the only thing I've learned over the last 26 years is that I'm wrong. Yeah. At almost every turn, I'm wrong. And one of my favorite things to do and I would encourage you to not do this, but is to just, I pull up Yahoo Finance and it says the market's up 100 points today because of fill in the blank, and the market's down 100 points today because of fill in the blank. And it's absolute baloney.
Yes.
And so I look at that and I think there's no, if you would have told me, and this is where I kind of like to do a test and say, what do I think the market's going to do? And then I'll watch and see what it's doing. Even today, if you would have said, hey, the market's going to be back from, I don't know where we touched bottom, 18,000 or something, back from that, I would have said no way. There's just no way. So this year, among all years, has caused incredible head scratching because this is we're talking about the coronavirus. The coronavirus was the thing that caused us to voluntarily shut down our economy,
Right.
For the first time ever. And if you talk to, and especially just living in northern Indiana, if you talk to your buddies in the RV industry or some of these other industries, they were having two of their best months ever in January and February, thinking, oh man, this is going to be a spectacular year. This is going to be the year of big bonuses and all these other things. And when everything shut down, they were convinced that they were wrong. Now they're back on that train again because if you look at the things that the coronavirus has done, it is, according to the CEO of Airbnb, it has changed the way recreation and hospitality and these other industries are going to be forever. And I can tell you this from experience, if you've tried to find a spot in a campground this summer, if you didn't already have it, you're not getting it.
You're exactly right. And it just underscores how crisis moments in the economy or in the stock market, there are winners and losers every time, right? And, the RV industry, it seemed like, man, aren't they kind of due up for a slowdown of some kind? Not anymore, right? Everybody wants an RV. I've even contemplated an RV, and I've said for years that I'm all camped out. I'm done camping.
That's right.
But now who knows, right?
So
I think you should get one, Josh.
So we certainly don't know where in the world this coronavirus thing goes from here, right? I mean, they're talking about, and if I'm trying to get these really, really smart technical terms, a second spike and then a second wave. Like, I think those are two different things, but I'm not supposed to wear my mask, or I am supposed to. I mean, we don't know. We can't even get the story straight, right? So how are we going to predict the future? What is it? Yogi Berra says prediction is always dangerous, especially if it's about the future. And so, I mean, it's impossible. But that's creating this cloud of uncertainty over the stock market and the economy. So that's a reason to be cautious and pessimistic. The one that freaks me out is valuations. What that means is the price of the stock market, and the stock market's just the value of companies. So let's demystify it. That's okay. If you wanted to buy Disney, here's the price of Disney. You can be an owner. And but when you compare that price that you're paying today for the profits of the company, that means you're paying a huge amount today for these measly profits. We are about to, if I can make a prediction, sorry, Yogi, you're wrong, because this one I think is going to be easy. I think we're going to break the record for highest PE ratio or most expensive stock market ever here within the next couple of months as we see earnings go through the floor for the second quarter. So we'll see. I want to pick that back up, valuations, and why I'm cautious about that. A couple other things. I think you might have heard there's an election coming up. We're going to talk about that and how that could play into the market. So a lot to come here on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. You're at the Wise Money Show channel. What you're watching right here is our weekly 1-hour talk show that airs right here every single week at 9 a.m. and then also on a couple radio stations in our local community here. If you're new to this channel, hit that subscribe button, turn on notifications, smash that like button, leave comments and questions below as well. Every single question, yeah, even the interesting ones, we'll get back to you. So make sure you follow us here. Thank you.
Okay.
Is that a real prediction? That
Yeah.
You think the PE, you're talking PEs will go to the highest in history,
Yeah, so basically,
higher than the dot-com bubble.
so we're at 22 right now, and the
Right.
highest was 25.
Yeah.
Call it 24, 25.
Back in
And-
the late 90s.
Yeah, and as we see profits come in, I do. Profits are going to come in terrible, and it might just be a flash in the pan. That's what we'll talk about. That's what Wall Street is expecting. But I don't know. So apparently, I did this. It wasn't a very popular video on YouTube. So if you're watching this, you're watching on YouTube. And I did a video about the most expensive stock market ever earlier, or 2 weeks ago. I talked about this, and I'm actually at the whiteboard. And the number of companies trading greater than 10 times sales, which again, as you know, means nothing. That
Right.
means nothing.
Right.
10 times sales, we're already at a higher number of the S&P 500 companies than we were back in 99, 2000.
So if you were one of those companies, you'd sell, right? I mean, if the logical thing to do would be,
Unless you believe that this is just artificially low temporarily and its profits are going to quickly return. Because that's how the stock market's behaving right now.
Sure.
I don't think so.
You don't think
You
the
don't
market's
think that's
behaving
what
that
it's
way?
doing,
No.
or
No, not
I
at all.
think it's all stimulus.
I think the market is reacting to all incentive to save has been removed.
yeah.
So the only incentive I have is to go risk on, and this mountain of cash that has been poured into the economy has made its way into the stock market.
Into
See,
the
I-
financial system. They haven't
Right.
made it into the economy
That's
yet.
where I would disagree
No,
as well.
I
that
said
it's-
that I'm saying the stock market.
Right.
yeah.
Because why it has, and this is why it has. Because if I've got cash and then I got stimulus money or something else or some sort of what have you, and I was thinking about the stock market, I put that money in the stock market because I know that I'm not going to bottom out. I don't need that cash. Boom. And so that's how I see it.
Yeah.
But hey, are we going to talk about the coronavirus in here and what I think we should do our, and maybe it should only be bonus content, but I think predictions.
Let's do it on the air.
Okay, let's do it on the air.
predictions of what?
Just remember,
Which of the three of us is going to get coronavirus first?
just remember the cancel culture. So whatever you say about the coronavirus today will be hate speech tomorrow, and you may be canceled.
Yep. All right, you can go first. You can be the jerk first.
Seems like I've been given that opportunity many times. All right.
Is the stock market too high? Is it too expensive? Is it going to break the record created during the tech bubble? They call it a bubble for a reason. History repeating itself. All sorts of questions. We're answering them today. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. I'm your host. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. If you want to stay up to date on all Wise Money content, you'll find us online, wisemoneyshow.com. Then all over social media, Facebook, YouTube, Twitter, wherever else, just search the Wise Money Show, follow us, and like us there. All right, so we're talking about the stock market, the unprecedented run that we've had so far this year, and we're only 6 months in. Where does it go from here? What should you do about it? Should you be pessimistic and cautious? Should you be bullish and optimistic? We're starting with the pessimism side. Left off on valuation. So basically, there's all sorts of examples where Wall Street or investors are risk on and they're happy to be risk on and not looking back. And here's an example. Lemonade. No, not the beverage, the company that is the hottest IPO on Wall Street this year. And they listed their stock, their IPO, around $28, and it quickly surged up to $80, making the company worth about $4 billion. Well, that's okay, right? Because the company probably created the cure for coronavirus or whatever. Nope, it's an insurance company. All they do is insurance. And they said they're going to use artificial intelligence and they're going to help the world. but no, they're just an insurance. And, well, they probably have really great sales. No, last year their sales were only $60 million. Oh, well, then they have great profits. No, last year they lost $108 million. But somehow Wall Street's pricing this thing at $4 billion. Tesla as well is just like the stock price is through the roof, and they've got all sorts of potential. However, if you look, I just saw a graph of this. If you look at revenue for Tesla over the past 3 years, it's pretty much static. Like even revenue, it hasn't made a profit. Even revenue is just static. So
I feel like you're right to compare this market to the dot-com bubble in a sense, because what was the theme back then? It was all about hot new technologies, new disruptive technologies that are going to dismantle existing industries, completely change the face of how we shop, how we do business, all of that. And here we are, 20 years later, and much of it is coming true finally.
Yep.
Right? There is more banking done online, and there is more shopping done online and everything. New technologies that are theoretically driving new capabilities are the hot theme these days.
I remember sitting in an Econ 201 hearing about a company that was going to deliver your groceries. And it was, you're never going to go to the grocery store again. And I thought, I wonder, yeah, that's interesting. And then it was like, a year later, it was, that was ridiculous. Stupid people, of course you're going to keep going to the grocery store. And guess what? I'm a subscriber to Shipt right now. Right? So it's happening.
Which is fascinating because at some point in time, we just need to do a show on all the things that the coronavirus has infected and changed. Because I have neighbors who have professional careers, and they deliver for Shipt, and it's their escape. They love delivering for Shipt.
A fun hobby, huh?
Yeah, it's and they got into it because their kids who live in a different town altogether when the university shut down, they started delivering for Shipt. And then she was looking at how much money her daughter made and said, well, I can do that.
Right.
I know how to drive a car.
Because they had been sidelined. They're certainly a very essential business, but not allowed to operate for a season, and so they were doing it, and it's pretty cool.
So we'll be talking more about valuations. I do think it's very close parallel to what happened in 2000, for the same reason you mentioned, Josh, but also because it was today's profit or loss doesn't matter because it will be profitable in the future, and that's even if you're not a disruptor. That's what Wall Street is thinking because, listen, this coronavirus, we will be past it at some point, and so today's poor profits or losses don't really matter because you'll be back on your feet in no time. And I don't know. No one knows.
Well, but the analysts are making their predictions. 2021 is when they see profits spiking back up, getting to all new highs, and maybe at that time justifying the high price that people are paying for stocks right now. But you go back to the end of last year, and part of the conversation we were having with clients is kind of this warning that, the stock market seems a little expensive-ish right now. It's on the higher end of the spectrum as far as what you pay versus what you get in profits out of that. And now it is spiked way higher.
I know. I'm looking at the chart right now.
Yeah.
It was really close to this dangerous threshold, dropped way down, and then has broken way through that threshold now. So anyway, okay, so Kevin, one of the big risks, this uncertainty with the coronavirus, and another big risk is the political climate and even the tensions with China. We'll touch on that, but you wanted to make some predictions about the coronavirus.
No, I didn't necessarily want. I love to think about what do you think is going to happen. And I was actually.
I thought you just said, guys, don't do this. I like to do this, but don't do it.
Right.
And now you're saying, let's do it?
Right, yeah, let's do it. Because so on March 29th, I go back to a text that I had with one of the smartest guys that I know. And he has, when God was passing out brains, Doug thought he said trains and said, give me the silver bullet here. I mean, he is just amazing. And so he said, and we were talking on March 29th, he said by the end of April, there'll be 10 million cases in the U.S. because he was looking at the the curve and the trajectory, and he said 2 weeks out there will be a million cases in the U.S. This was March 29th. So 2 weeks later, we were at 675-ish. And now here we are, April, May, 3+ months later, we're at 3 million cases in the U.S., not 10 million. So the only thing that we've known is some of the smartest people that we might know personally or we've watched or listened to on TV, they've all been wrong, all the way from don't wear a mask to just go right on down the line. So I think, and the tricky thing is you can't really say anything about this without being accused of being on one side or the other.
Sure.
Yeah.
And as far as I can tell, the danger when we were looking early on at this virus is going to kill 5 to 10% of the people that it infects, and now we're down to less than 1%. And I believe it appears as though that number is going to keep getting smaller, and that number gets smaller. There were 5 states, New York, New Jersey, Pennsylvania, Michigan, and California, where the governor said, you have to allow COVID positive patients to go into nursing homes. When that went into the nursing homes and spread like wildfire through the nursing homes and hit people with comorbidity issues, that's what skewed the numbers. So I think I think a lot of us are hostage and maybe fearful because we didn't pay enough attention in our statistics class. And so certainly by now, if you haven't gotten it, you've certainly gotten a warning long enough to get yourself physically kind of ready to get it. And it seems like we're all going to get it. So here we go. If prediction, they're going to open up the schools this fall, and we're going to have 2 sets of people, two different tries. One is I'm going to send kids to school 2 days a week. The other is 5 days a week. I think the 5-day-a-weekers, it's going to work. That's my prediction.
And do you think we get a second shutdown across the country?
No, I don't. I think the yearning and longing for freedom has people saying, I'm not going to comply this time.
Yeah. I actually, sorry to not have drama here, but I actually completely agree with you. We got a lot more to hit on the pessimistic side as well as the optimistic side. So more coming up here on the Wise Money Show with Korhorn Financial Group. All right. Yeah, I completely agree. So, local stuff. Penn, I don't know what you guys have heard or whatever, but Penn is asking people what they want to do. You want to send your kids, or do you want to keep them home?
That's what happened in our school district, too. We got a survey.
Yeah, a survey.
Would you send your kids if they have to wear a mask every day?
No.
Would you just keep them home?
But I think for Penn, and I don't... I delegate these responsibilities to the person with the most skill, and so. But I think there's a distinction with Penn. It wasn't what would you prefer. It was what do you do? You're signing up, and like you're making your choice. And if you choose to stay at home, but not enough kids stay at home, we might not allow that. But word is, plenty of people are saying stay at home.
And my understanding is that Penn will have specific teachers assigned to the e-learning crowd versus the
which I think is very
location.
dangerous because at least typically Penn school elementary schools, they cluster the kids based on aptitude, and they align them.
Schools do.
Some schools and align them with teachers. Well, now that's going to be done. You're going to be, clustering based on learning preference. So,
yeah, I mean, dude, we have to do the show on what is going to change, because if this goes on long enough, it will take a wrecking ball to the educational institution. Yeah. I personally believe.
Well,
I'm surprised there haven't been more retirement announcements among teachers. And
I read a great article in one of my favorite sources of news, the USA Today, Right. And it was talking, it was a 62-year-old teacher, and she was talking about how she's terrified to go back in the classroom, but she really wanted to teach for 3 more years to maximize her retirement. And I'm thinking that's atta girl. That's what I love. Someone who's all about it for the kids. Right? Like her passion is to teach social studies for the maximization of her pension. Are you kidding me? And they published that. It's embarrassing. I'm ashamed and embarrassed, and I'm not even her.
Thankfully, that's not most teachers, right?
Yeah.
And you hope it's not.
It's
your
not
kids.
most teachers, but I early on, I met with a guy. Actually, I went to church with him at the time, and he's like, "Yeah, I'm gonna teach." I don't know if it was 2 or 3 more years. He's like, "Yep, I really need to teach 2 or 3 more years so I can get my mortgage paid off." And I'm thinking, is that how we think? I mean, maybe that is how I think about it. I like to think that most teachers, at least most of the teachers I know, don't think like that. Most of the teachers, and certainly in the Big Rapids system, were passionate about what they were doing and changing lives and changing the world.
Well,
So-
you'd hope that for every profession,
Yeah,
right?
I
That
was
they
thinking
see it
that
as a
too.
calling,
Yep.
not a job. And
Yeah.
but
Okay,
Sometimes.
what's next here, Mikey B?
So third segment. So I do want to. We got to touch on the election, and then depending on how long that goes, we might just lean into how do you apply this pessimism.
Do we say anything about the S&P closing up, 19.95% for its best quarter since the fourth quarter of 1998?
I can lead with something like that.
I mean, and do you want me to share what I'm looking at? Because
No, I mean we gotta. So this is third segment. So we need
gotta
to have
finish
I don't think we're going to finish, but there needs to be a finish.
a logical.
Yeah.
okay, so I slacked it to you.
Okay. Stock market broke a couple of records this year in 2020. I'm not talking about new highs, although it did that. I'm talking about the fastest decline off of an all-time high, and on the opposite end of the spectrum, the very best 50 days in the stock market ever. What do you make of all of this, and what should you do? We're about to tell you. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Now that you are free to go about the country, if you're listening to podcasts, you can catch every episode of the Wise Money Show wherever you listen to podcasts. Spotify, Google Play, or whatever they're calling it, iTunes. Just search the Wise Money Show. Subscribe to it. Give us a rating. We appreciate that. And you can catch every episode right there. All right, so we're about to turn into, well, how do you apply all of this? But there's another reason to be cautious. And I would tell you it's complete noise, and that's this presidential election, if you haven't heard about that. It actually did. It was sort of refreshing. For about 2 months, we didn't even remember there was an election.
Yeah, I was gonna say
And-
the noise hasn't been as bad as it could have been.
And
right?
now it feels like it's all about the election. It's like we're turning back into all the drama. And, obviously there's some very real social items going on across the country. And that kind of becomes a political issue. And maybe it was a political issue to begin with. I don't know. But that is typically, that causes some uncertainty and typically causes investors to wonder, how do I play this? What do I do with my investments with the stock market, in the stock market because of the election? Well, I'll make it really clear, and then we're going to turn to what you should do about this. If you look at the presidential election or the presidential cycle, okay, so the 4 years of a president's term, which one does the best in the stock market? Well, here's the news report. They're all good. They're all good, okay? And surprisingly, the best year is the fourth year, which is the election year. So everyone is like, every 4 years, well, what should I do with my investments? The fourth year is the best year. What the studies have actually found is that investors who have a different political opinion than what's in power at the time, that research is extremely clear. investors with the opposing political view as what's in power do poorly.
They
They
underperform.
underperform. That's the only stat that you need to be aware of in the research.
That is the warning that you had to hear today, too, right?
Yeah.
Because on both sides of the aisle, we have, I hear it all the time. If so-and-so wins, the stock market's going to crash. You know, we heard it back when it was Hillary and Trump running for election. And if Hillary wins, the whole world's going to fall apart. No, if Trump wins, the whole world's going to fall apart. And the bet you made on who was going to win with your investments either hurt you or it helped you. But you shouldn't be making
And
bets.
statistically, it hurts you. Now, for me, Biden and the change in tax plan, that does concern me. I mean, so I'm not saying you shouldn't be concerned or you shouldn't have, your brain turned on. Mine is on, I'm aware. But the research says you tend to, that's the big mistake.
So, right, if you go back to 2012, I remember certain folks saying, hey, if Barack Obama is elected to a second term, this is the end. And for the most part, when I'm listening to people opine about their politics in a client appointment, they're not as concerned about the stock market as they are just for the country in general.
Yeah.
So there were some people that were for Tim Romney and dyslexic folks, but they if you look at that, they said Barack Obama and the folks that responded missed an opportunity. There were folks that said, hey, if Hillary gets elected or Donald gets elected in 2016, and we saw there was a general malaise in the market from about the middle of 2014 till October of 2016. And I remember people, new folks coming in saying, hey, the guy that sells me investments hasn't done a good job for me at all in the last 2 years. I think we'd like you to help us. And we're looking at that, and I'm looking going, yeah, guess what? He's gotten you market results. It's not your guy or your gal. It's the market that's been the stinker here.
Well, okay, so this is the segue then. With all that pessimism or reason for cautiousness, what do you do? What do you do in the face of all this uncertainty, in the face of these potential bubble, in the face of China a couple weeks ago running a tabloid saying buy stocks, and their market goes up 11% in a day because China ran propaganda. What do you do?
That's not the
with
first time they've done that either.
So what do you do with all this if you're an average investor? What do you do?
The message that I've been communicating to clients as we've been reviewing their performance, and it's fun to be able to sit down with clients and show them that they've weathered this storm really quite well. And most of them are positive on the year.
Yeah.
It does feel a little weird, as you were saying in an earlier segment, to tell them, hey, we're basically flat on the year, or you're up just a little bit. But you have not been flat. It has been a roller coaster ride. And the fact that you saw the fastest decline in history, the stock market falling as sharply as it did, and a meteoric rebound, means that possibly there's an opportunity given to you to make sure your portfolio is structured properly for the next, 10, 20 years. You need to be thinking long term, not short term. This is not about who's going to win the next election. This is not about, whether coronavirus cases are going to spike or China and U.S. are going to start butting heads again. This is about, are you positioned to achieve your goals? And there are many people who are taking more risk than they realize, and you've been given an opportunity to pare back that risk without selling at depressed prices right now.
For sure. Make sure that your asset allocation, which is probably the second most important decision you're going to make in your lifetime financially, make sure that your asset allocation is correct. And then make sure if you're going to be doing any kind of CARES Act distribution, if the market is back close to break even, it's still, depending on the day you look at it, a little bit underwater. And if you say, hey, I've got a diversified portfolio, it's even more underwater because of international emergency. whatever. But still, if I'm a little bit underwater this year and I needed to take some money out, that's not bad because I was probably up meaningfully last year.
Right.
So net, I'm probably ahead. Like you said, Josh, I've kind of gotten a second bite at the apple here to do something that I couldn't have done 3 months ago, for sure would not have wanted to do 3 months ago.
Exactly. And for some people, that might be, hey, I need to make sure I've got enough cash on hand to cover my needs for the next year or two. If you're in retirement or approaching retirement, one of the most important decisions that you make with your portfolio is how much cash do I have on hand so that I have a liquid, safe, stable place to go to get cash as I need it. And that way I don't have to sell something cheap in order to fund a need in my life at the exact wrong time.
I'm a buyer. You know, I don't need the money for 30 years. You know, so don't get caught up in the noise right now, or even listen to all of our reasons for pessimism. That's all short term. That's all having the right expectations for what might be right around the corner. But you don't need if you don't need the money for decades, buy. You're buying into the world's best enterprises. But as is sort of the undercurrent always is whatever your risk tolerances and your investment approaches, it's got to be connected to your overall financial plan. The reason why our clients are, most of them, up right now is because their investment approach has been connected to their plan, and they've got a core strategy and a dynamic momentum type strategy. So, all right. Okay, we haven't talked much about the real tangible reasons to be optimistic. We're going to hit that next. That and more coming up here on the Wise Money Show with Korhorn Financial Group. Yeah, that is, I fear for the young crowd. If they, if you're a millennial, you got into the workforce, started saving when no one wanted to, so you might have said, I can't trust stocks. And then right about the time you thought maybe you could, you're walloped again.
Although there's a lot of evidence out there that many young investors who are kind of dabbling in the stock market, they became buyers during this dip.
Yeah.
And that also can be dangerous because you get this false sense of security. Like, hey, I happened to buy some dogs that were, way too cheap, and now they're rebounding sharply because they're being bid up by a lot of buyers. You may say, man, I've got the Midas touch here.
Yeah,
I can't lose, right?
I have talked to a couple of folks that are convinced they missed their calling because they, the old blind squirrel routine. They bought an airline stock, or they bought this or that or the other thing, and it's. I mean, have you looked at our?
Yeah, it's unbelievable.
Yeah, the results.
The dynamic models.
It's just phenomenal.
Yeah.
Was it Charlie Munger that even turkeys can fly in a tornado? I think that's my favorite of the analogies.
He's had some great ones.
That's hilarious.
All right. Well, I doubt we'll get into questions. I think we need to hit again what you should be doing about it. But there's some reasons to be optimistic. The first one that listed there is first two. Although we can't talk too much about details.
But somehow we got to talk about. The only thing I don't want people to get fixated on is the idea that we are investment guys.
Right.
Like, we're not.
Right. So that's why I tried to sneak that in at the last minute to make sure that the folks on WFRN would hear that. So, but I mean, that needs to be the theme. That really this short-term stuff should not matter.
No. The theme should be, don't think about investments.
Right.
Have your financial planner think about investments, and you think about your financial planner.
Fondly.
I think about you every day,
13.
Kevin.
Fourth segment. How do you make a wise financial planning decision with your investments? Not get fixated on the noise, not get fixated on what's happening in the investment world. How do you make a wise choice so that you have freedom in your life in the face of all this uncertainty. So that's what we're talking about right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. I am your host here in the KFG studios with Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel, as well as daily updates every single business day, helping you apply wisdom in your financial life to what in the world is going on in the economy. So find us there on YouTube. Just search Wise Money Show, subscribe, and like us there. We appreciate that. Okay, so there are, despite the many, many reasons to be short-term pessimistic or cautious about the market, there's some actual tangible reasons to be optimistic. And the very, 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 very first one, is the Powell put, or the Federal Reserve. What did he say? We've got limitless options.
Yeah.
Well, yeah.
Unlimited options to boost the economy. And it's not just Powell. It's basically this orchestrated event by all central banks, really, across the globe, that central banks will do anything and everything. Now, I think in the short term, it's so crazy we're talking about all-time highs, because in the short term, I say that helped us avoid depression. And now we're talking all-time highs. But I think it creates more risk and potentially more volatility for the future. But one reason to be optimistic is, listen, the Fed's got your back.
Yeah, you're exactly right. And in the investment world, in the economic world, we call that monetary policy. There's monetary policy and fiscal policy. They're two different ways of pouring fertilizer on the economic lawn, so to speak. And the fiscal policy is when Congress takes action and they start stimulating by the government spending more money or reducing taxes, keeping money in consumers' pockets so that they'll spend it and stimulate the economy. What you're talking about is monetary policy, where the Fed, by lowering interest rates or pumping more liquidity into the economy, it allows to stimulate or to try to prop up the economy. Unfortunately, it can create some bubble scenarios too.
I'm smiling because you use old terms. I mean, that comment was dated. That the only thing the Fed does is they lower interest rates and
that's the
inject
most
money.
classic.
Well, but
they're getting very creative these days, aren't they?
Wow, like I actually think they said they'd never buy individual securities, but they are.
Yeah,
they're buying junk. They're buying junk bonds. So if I'm a junk bond, if I make money by opportunistically buying depressed prices, the Fed just stepped in front of you, and they actually maybe pushed you out of line because they're going to buy that junk, and then and they're buying stocks and everything else. I mean, they're the buy. They want to own it all. One of the YouTube guys I know, Kevin and I follow, he says the Fed wants to own everything. And it's a little scary. But at the same time, if you're just an investor in the stock market, I mean, the Fed has basically put in a floor, it seems.
Yeah, it's like any crisis point out there, any asset that is depressed or you can't sell it, they'll be a buyer for it, right? Mm-hmm. And what they're doing is they're creating an exit strategy for people so that they don't get caught in the crisis, which has a domino effect throughout the whole economy potentially.
And certainly, what they've done is they've encouraged. There are certain moral hazards about what's happened. And I'm an optimist, but I look at this and it's a little bit discouraging. And I think the message to our clients is, hey, you've got an opportunity right now, a golden opportunity to improve your balance sheet, quite possibly. So take that opportunity. Lots of folks that we're talking to have mortgages somewhere between 4 to 4.5% that they might have refinanced 3 or 4 years ago, thinking, I will never get a rate like this again. And the rates are there. Now you have, Wells Fargo coming out telling new clients they need $1 million in balances for certain mortgage refinancing. So the banks are getting very selective. Very
Can you trust what they say anyway?
Wells Fargo, very trustworthy.
Yeah.
Yes.
So-
Mike, I look at my 17 accounts that I've got at Wells Fargo.
But 30-year mortgage rates hit an all-time low last 2 weeks ago, and that's something that our own Kevin S. Korhorn was right on. He said 30-year rates will get to 3%, and there you have it.
Well, I love that you point that out as an opportunity for people to improve their financial position.
Absolutely.
To refinance or restructure your debt can reduce some of the money that's bleeding out in the form of interest. But here's the temptation. In low interest rate environments like this, you may also be tempted to just go get more debt. Because if you can borrow money so cheap and you can go invest it in a business, a piece of property, a car, I use that word facetiously, obviously. It's not an investment. But the point is, cheap debt drives behavior sometimes.
Right.
And sometimes it drives behavior in the wrong direction.
Risky behavior. And that's an interesting segue, because I would also cite a reason for optimism. So that our country, our economy is, if you really simplified, you'd say 2/3 consumer, 1/3 government. And we already said government wants to spend money, right? And they're trying to buy some votes. But the consumer somehow seems really healthy. There's very anecdotal evidence, but my kids are in baseball, softball, and no one is worried about this little virus at Little League parks. I mean, they are just booming. And so as I'm driving around, driving to park, driving to practice, whatever, the number of paper license plates that I see it's noticeably higher. And why would you have a paper license plate? Because you just bought a new vehicle. And I know that the numbers for these vehicle sales were way down in the second quarter, but just anecdotally, it seems like there's a ton of new cars. The housing market is still extremely strong. And so I think that somehow the consumer is healthy. Now, hopefully they don't go from healthy to unhealthy because they've taken out a bunch of cheap debt and blah, blah, blah. But somehow the consumer is healthy.
The case that you'd make for the consumer being healthy is the longest and slowest recovery that we ever saw over a 10-plus year period. The consumer didn't have a chance to get frenetic and overheated. And so they've had to get better and better and better at managing in kind of a slow sledding time period. And I think the same is true of businesses. I mean, in 2008 and 2009, businesses just blew up left and right. And I'm looking at this, and certainly a lot of folks have been hurt. But I think, at the tail end of a long, slow recovery, to have an event like this is what stopped the recovery. I think it does give me cause for optimism.
Let me pile into this optimistic party here a little bit too, because I'm looking at a chart here that's showing the portion of most households' income that goes towards debt payments, and it's the lowest it's been in my lifetime.
Wow.
Okay. The highest point, no surprise, came at the end of the housing bubble, 2007, that fourth quarter, right before the huge drop off. Debt was like you couldn't get enough of it at that point, and people were making huge payments and everything. It tells me that the story here is this sliding amount that's going towards debt payments. It shows me that the consumer has learned their lesson. Mm-hmm. The last crisis changed us as a nation, and I'm hopeful that it remains that way, and maybe we become even we have even less of an appetite for debt moving forward.
Mm-hmm. One final thing I'll throw in there before we sum it all up is there is still a ton of money on the sidelines, a ton of money, and lots of institutions, lots of financial professionals are cautious in the short term. The folks that try to make short-term bets, they're not investing, they're betting, they're gambling. They've got a lot of money sitting on the sidelines because they're waiting for a pullback, which almost always means there won't be one. Because any little pullback, that money gets sucked into the market and it pushes the stocks right back up. So there's really, really meaningful reasons in the face of all this uncertainty to be optimistic. Now, here we go. We said it a little bit last segment, but what do you do with this? I mean, guys, your investments should not get a disproportionate amount of attention in your financial life. If they do, they start occupying too much of your brain space and you're not able to live an enjoyable life. You need to have an overall comprehensive financial plan working with the CFP, and you need to know what your disciplined long-term investment strategies are and that those strategies fit in with your financial plan. And then after that, you just go to sleep at night. I mean, just peacefully, and don't worry about the noise.
Hey, and here's an example of a way that your investment should fit into that financial plan you were just talking about. The crossroad between your investment strategy and your tax strategy may be something that you need to be revisiting right now. You may have been caught with the wrong types of investments in the wrong accounts. You have most likely some tax shelters that are deferring taxes or they're postponing taxes, and you have some tax shelters that are eliminating taxes, tax-free type of accounts. And then you may have others where, as you make investment changes within them from year to year, you will pay the taxes as you go. And the point here is your selection of investments in each of those various types of buckets matters. The way that you use tax diversification matters. And with the market giving us a nice rebound, if you don't have that structured properly, now may be an opportunity for you to rethink it.
Yeah. Sorry, Kevin was, if you heard some breathing there, I think...
Was that me?
I think so. I was watching. So here's the other thing I would tell you. I mean, we're talking about your financial plan, and if you're in your 40s or 50s, we've talked about this before, you need to have your retirement plan built by that time, okay? If you're in your 30s or 20s, or if you've got kids in their 30s or 20s, you got to be buyers right now. You've got to be buyers, and you got to not look at, well, did I buy in at the wrong quarter? No, I think risk is elevated. Expected near-term returns are lower because there's going to be greater volatility. I just think that. So you need to be buying. You need to be buying consistently. If you're cautious or you need to fix that overall allocation, do so with rebalancing. But your new money, make sure that you're still investing. The way you want to do this is to be a buyer during this volatility. And so work with your certified financial planner. Have a disciplined investment philosophy that works in good times and bad, and make sure it's all connected to your overall financial plan. That's clarity and confidence right there. So, all right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, and all of us at KFG, we'll see you next time for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.